Hey, what's up guys? It's Ezekiel here. So let me ask you this. Have you ever looked at the charts and you thought like, alright, what now? There is like no clear direction. There is no strong trend. It's just price bouncing up and down, right? And doing fake moves and stopping you out. So you wait for the breakout. Doesn't come, right? You try to catch a reversal and then you get stopped out. Sounds familiar? Alright, so here's the reality. Most traders, they get crushed in these rangy market conditions because they don't know what's really happening, right? But today, I'm going to change that. I'm going to show you the hidden playbook on how to trade the ranging markets the right way so that you can get in non-stop on all these cash cow trades and know exactly when to get in on breakouts after a ranging market with high probability. So this is a masterclass on range trading, and this is the only video on range trading that you need to watch. Before we even talk about range trading strategies, you need to know this first. So this is something that most traders skip. That is like a big mistake. So a trending market is when price moves clearly, right? In one definitive direction, right? It's either going upwards or downwards. So understanding these market types is essential so that you can apply the right trading strategies in the right market structure. If it's going uptrend, if it's going upwards, it's going uptrend. If it's going downwards, it's got a downtrend, obviously, right? So now, usually, this is the type of market that traders, they prefer to trade because the movement in a trending market tends to be more predictable, right? So now, on the other hand, we got the ranging markets, right? This is where price, it kind of moves unpredictably and it lacks a clear direction. So this market can seem like it's chaotic, but with the right strategies, they still offer like plenty of trading opportunities. So now that we covered the market types, let's talk about one of the most things that traders fear. So traders, they often avoid what? They're trading the ranging markets because it's harder to predict, right? The lack of clear direction, it makes it challenging to determine where would price go next, right? So another reason that traders, they steer clear of these markets is that most indicators, they don't perform well in these conditions and they lead to a lot less reliable signals. Let me give you an example. This is the MACD, right? The MACD indicator, right? So if we are trying to apply the MACD indicator on a ranging market, right? You can see that it is showing us what? Multiple false signals. And as a result, we would end up with a lot of losing trades. Unfortunately, range markets are impossible to avoid. So why? Studies, research shows that the financial markets, right? No matter what kind of vehicles, the financial markets as a whole, right? Whether it's Forex, stocks, crypto, commodities, etc., they only tend to trend around 30% of the time, while the remaining 70% of the time is spent moving sideways within a range. So that means that the market, it ranges most of the time. As traders, instead of us avoiding them, it is important to learn how to trade these markets effectively, isn't it? Let's take advantage of them. In this video, that's what I'm going to do, right? I'm going to show you the best strategies that you can use to profit in these kind of conditions. Hey guys, quick heads up. If you are trading or you're planning to start, you need to check this out. It's called Markets for You, previously known as Forex for You. So they have been around since 2007 and now in 2025, they have completely leveled up. It's basically an all-in-one platform. Over 250 instruments, including Forex, indices, stocks, crypto, you name it. And the trading conditions, crazy tight. Spreads from 0.1 pip, 0.1 second execution, and up to 1:4,000 leverage. Right? There's no minimum deposit, there's no fees on deposit or withdrawals, and both are processed like really fast. They also have built-in copy trading, which is super beginner friendly, right? You can copy the top traders, which are fully automated with built-in risk control. And if you are already a profitable trader, you can even earn when others follow you. Security-wise, they are fully regulated. You can keep your funds in segregated accounts, and their app is one of the best I've seen. Their verification also just takes minutes. So whether you are just starting or you're already deep in the game, Markets For You is worth a look. I'll drop the link below. Check it out after this video. First off, let's break down what you need to know to successfully trade in a ranging market. Alright, so step by step, you need to know how to actually spot a ranging market first before it traps you. These markets, they typically are much easier to recognize after they have already formed, right? As price, they tend to move within a clear range or channel. So however, when the ranging market is still in the process of forming, it can be much harder to spot. Here's a simple trick that I like to use, is to fully focus on the market structure, which can help you to review early signs of the range developing. So let me show you an example, right? We can see over here that the market is what? Initially is moving up in a clear uptrend, right? So now, why is this considered an uptrend? It's all about what? Price structure. The market moves upwards, makes a pullback, climbs up higher again. The key here is that as price rises, it consistently breaks the previous high, right? Forming what we call the higher highs, right? And the higher lows. So the highs and the lows of the price keep increasing, which is why the movement is classified as an uptrend, right? So then price goes up again, pulls back down, but this time round, here's what happened. It fails to break above the previous high, right? So this marks a significant shift in the market structure. It signals that the uptrend might now be losing its momentum. Here's what happens next. Price went up and came back down, but this time it failed to break above the previous high, right? And then it happens again a second time. So price goes up and pulls back down, but once more it also fails to surpass the previous high. So at this point, it becomes clear that the market is now starting to lose its upwards momentum. It shows what? It shows that the market structure has now shifted, right? It was initially forming higher highs, higher lows, but now the pattern has changed. Instead of forming another high, price failed twice and began moving sideways. So based on this market structure, we can now clearly identify that the market is now ranging. Okay, so now that is the uptrend, right? So now let's move into the downtrend, right? Take a look at this, right? Price is initially moving a clear downtrend, forming what? Lower highs and lower lows, right? Price moves down, comes back up, fails to form a lower low, and this happens again. Price drops and then it recovers again, and it still failed to create another lower low. So this is a shift in market structure that signals a change from a downward trend into a ranging market. Now that we have confirmed that the market is ranging, here's the next move, right, that you're gonna make. Right, so there are a couple of ways of why we draw these key levels. Right, the first one is to determine the area where price is still considered ranging. So if price moves beyond one of these levels, it indicates that the market is no longer in a range. So the second reason is also to establish our trading zone. So as long as price it stays within this zone, this is where we can apply our ranging market strategy, like our cash cow strategy, inside this zone itself. But here's the thing, right? It's gonna be very rare to find the ranging market that moves perfectly between the key levels like this. I gotta be real. I'm not gonna show you some textbook theory. No. Most ranging market looks more like this, where price, it doesn't touch the key levels like perfectly. As you can see, some candles, they may overlap the levels, right? In some cases, price might not even touch the key levels at all. Okay, here's the thing. It's fine, right? They're all perfectly fine. This is how the market looks. Remember, we are treating the support and resistance. They are like general areas. They are not just solid lines alone. So now, let's talk about how to actually trade inside the range. For entry, what we want to do is we want to capitalize on price bouncing off the key levels. All right, so take a look at this. Price starts in a what? In an uptrend. All right, so then before moving sideways, we can identify a level of resistance above and a level of support below. Right, so this is like the first thing that we want to do. Notice the pattern. Each time price hits a key level, it tends to reverse. So for instance, price moves down, hits the key level and reverses upwards. So now this happens again. Price moves down, touch the key level and then reverses back upwards again. So the same pattern occurs at the support and also at the resistance level above. Price goes up, hits the key level, reverse downwards. If you take a look at current level right now, you will notice that it is touching the resistance level once again. So based on the previous pattern, this could indicate what? That price is likely to reverse from this level. So this gives it a good opportunity, right, for us to take a short position. But here's the thing. This is something that throws most traders off. Price can reverse even if it hasn't touched the key level, like in this case. For example, you take a look at this. We can see that the market is in a range. And then we identify by drawing the level of resistance and level of support, right? So you notice that from the past, price clearly respect the levels, right? And it often bounces off after hitting them. However, if you look at the recent price action, you see that the market moved down and reversed upwards immediately without even touching the support level. All right, and then after that, it moved down a second time and reversed upwards again. However, if you look closely, you will notice that price is now reacting to a new key level instead of the old one. So this is exactly why you should always watch for new key levels that may form. Price doesn't have to react like exclusively to just one key level. No, it can always respond to newer levels that develop along the way. And this is something that most traders, they fail to understand. Once price creates a new key level and it respects it, right? You can look to enter at these key levels when price bounces off it. So if it respects the original level, fantastic, right? We already got that in the bag. But when it starts creating new key levels, this is where you now know, oh, this is now a new key level. It respects once, respects twice. The second time or the third time can be the trigger for a good entry with added confirmation, such as candlestick patterns. For example, the doji, the engulfing bars, either in the same time frame. So for example, in this ranging market, right, at the key support level, at the key levels, you decided to enter because it respects, right? Or if it makes the new level and then you want to enter, right? But don't just jump in yet, right? You want to add in candlestick patterns. If they form in the same time frame, fantastic. But if they don't form in the same time frame, you can drop a time frame down. So for example, let's say if I'm trading the 4 hour, I would drop down to the 1 hour to see, because the levels are going to be the same, right? Is there candlestick patterns over there as well? The ranging market can be a really good cash cow, right? Where you can get in and out of the range, right? You buy at the support and then you close your trade at resistance level. And then you sell at resistance level and you close your trade when it hits the support. And then you rinse and repeat, right? So it's a fantastic cash cow. But price is eventually going to break, right? And you do not want to get in too late in the range-bound markets when it's going to break, isn't it? So here's what you can do, is to look at the number of candles, the range in the last two range market of that very pair. So for example, in the last recent range, especially the most recent one, see what is the range of candles. For example, let's say it's about 40 to 60 candles, that range. And it's pretty standard for this pair in the last two range. So now, when you look at this current range that is forming, and let's say so far, right, the number of candles is about 20 candles, okay? So this is where you know with higher probability that the range still has room for it to continue ranging, isn't it? Because the average is what? 40 to 60, right? But if it's already around 40 candles, which is about the same as the previous range when it broke out, that's where you should now change your strategy from trading inside the range to now be looking for a breakout trade instead. Good. So now let's go deeper. Narrow ranging markets, they occur when the distance between the upper and the lower levels are so small and it leaves little room for price to move inside it. So as a result, you wouldn't be able to trade these markets effectively, right? Using the cash cow method. Ding dong, ding dong, ding dong, ding dong. No, right? It's going to be really hard because it's so small, right? So the best way to take advantage of this type of narrow ranging market is what? Is to trade the breakout strategy. So the reason for this is that when the market moves in a narrow range, range. It indicates that the price is consolidating. So typically, after a period of consolidation, which is what you can also call a build up, price is likely going to make a significant move. So when markets are moving within a narrow range, it is a sign that the price is consolidating. And typically, after this consolidation, this build up of energy, of momentum, a breakout is going to occur. So now, this is where the opportunity is showing you. All right, so now you understand this. Now, here's how the strategy works. We find a narrow ranging market, right? Which is identified by what? Multiple small candles. Small candles are moving sideways and possibly in an erratic manner like this. Here's a tip. This kind of markets can be easier to spot in lower time frames, right? For example, even up to the 1 minute to the 15-minute charts. I mean, they are there in the higher time frames, right? But they are a lot more and easier to find in the lower charts as well. So it doesn't matter what time frame you are trading. What I'm trying to tell you is if you want to find a lot of such of this, there are a lot of them in the lower time frames. Other than that, you can find them in any other time frames as well. Once you have identified the narrow ranging market, right, we got to move to the next step. We want to draw the key levels. So the level which is the resistance above and the level of the support below, right? You do not want to draw them too closely. Yeah? You want to give them enough space for price to move in between, right? So this will help you to avoid false breakout later on. All right, so now, once you have drawn the levels, here's the next thing, right? The next question is, will this breakout happen to the upside or to the downside? Right, so you got to keep in mind that false breakout are very common in a narrow ranging market. So you got to see textbook theory. This is real life. It's not that it's going to break out or it's going to be real deal. It's going to be, there are a lot of false breakout in a narrow ranging market, which is also the reason why traders avoid range bound markets, right? Because of all these false breakouts. So here's how you progress from this, right? So one simple trick that I use to avoid all these false breakout is to wait for a momentum candle that breaks out of the key level. All right, so a momentum candle is typically a large candle that indicates strong price movement. All right, so if there is no one large candle, one big candle, it can also be multiple medium-sized candle of the same color. Obviously, if going up, you want the green candles, right? Same color, medium-sized candles, right? Indicating is consistent momentum. All right, so let me show you how this works. So if you take a look at this, you see price goes up and it breaks above the resistance level of this narrow range, right? However, if you take a look at the size of the candle that broke out, it's kind of too small to be classified as a momentum candle, right? So that means what? That means, no, we are not going to take any position yet. Because why? It's likely going to be a false breakout, right? So now, if you see what happens, price came down and then moves back up. And this time around, it breaks above the resistance level once again. But this time, it is a big green candle that breaks out. So indicating what? That we now have a momentum candle. So based on this, it's likely that this breakout is going to happen right now and going to go to the upside. Right? So then what we're going to do, right? This gives us the opportunity to enter on a buy trade, isn't it? And if you take a look, this momentum candle also closes above the previous false break high. And that itself is a very powerful break of structure as well. Plus the momentum of this bullish candle. It gives a huge probability that this range bound market that has the build up is likely going to go. This is gold. This is gold, right? This is gold. Now, for your stop loss, where are you going to place it, right? You can place below the narrow range support level, slightly below it, right? So even though if let's say this break upwards didn't work out and it come back down like a false break, our stop loss is still in a safe level, right? Until it breaks downwards, and that's going to be a change of direction, right? Because this range and then it breaks downwards, it's going to be a change of direction. That's where you want to get out of this trade as well, right? So otherwise, this stop loss level is going to be a safe spot, right? Where if price moves up after this forms, this is a narrow range. So the risk is actually pretty low. That gives us a very good risk to reward ratio. All right, and now since this is like a lower time frame narrow range, right? When price breaks out, where is our take profit level, right? We can aim for our take profit level at the next level of the higher time frame, right? So for example, let's say if we are looking at a 1 hour time frame in this narrow range, right? We can jump to the 4 hour time frame to see where is the next level of rejection, and then we use that next key level as our take profit level. So as you can see, it's a lower time frame risk with a higher time frame reward. All right, good. All right, so now let's wrap it up. ranging market makes up of what? 70% of the market. Here's the thing, most traders, they avoid it. But like I told you, it can be very profitable if you know how to trade them properly, like using the cash cow method. You got to learn how to identify the market shift from a trending market to a range bound market, right? Then we identify the key levels like the support and resistance level, right? To create our trading zone. But here's the thing, trading zones can change in the ranging market. When the new levels form, you want to align yourself with them itself. So now, use candlestick patterns such as the doji, the engulfing patterns, right? Either in the same time frame if there is for entry, or you drop to a lower time frame to find them. So then you can identify narrow ranges and then you catch the breakouts with strong price movement, right? After this consolidation, this build up, right? Using momentum candles, right? And then you got a safe stop loss placement for a fantastic risk to reward ratio with the two different time frames. All right, so as you can see, there is really no need to avoid ranging markets, right? With the right understanding, this sideways market is actually the best spot for cashing in on multiple trades, in and out, in and out, in and out. These are like your what? Like your daily paycheck. And then the trending markets, ooh, they are your big payday. All right, so especially there are certain pairs where the market can range a long time, and that's the beautiful part, right? And when it's time for a breakout, you can also catch it right when it takes off. Good. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.